Jessica bought Bitcoin at $45,000 per coin in late 2023. She was not wealthy. She was a nurse making $65,000 a year, but she had listened to enough podcasts and read enough online forums and heard enough stories about people getting rich that she decided to invest her $15,000 emergency fund into Bitcoin. She was going to hold it long term. She was going to be patient. She was going to retire early. In March 2024, Bitcoin dropped to $40,000. She held. In June, it went to $38,000. She still held. By September, it was trading at $42,000, and she was down $5,000 on her investment. Her emergency fund was gone, not invested, gone. She sold in October at a loss. She needed the money. Her car had a problem, and she could not afford to fix it without dipping into her remaining savings. She got out with about $11,000 left of her original $15,000 emergency fund. Jessica did not get scammed, not exactly. Bitcoin is a real thing. It trades on real exchanges. The price moves are real. But she got convinced to put money into something she did not understand at a price that was not sustainable, based on a narrative that was more about hope than reality. That is not a scam by technical definition, but it functions exactly like one for the people who lose money. Here is what makes Bitcoin confusing to talk about honestly. It is a real technology. Blockchain is a legitimate innovation. Decentralized currency is a genuinely interesting idea that some people care about deeply for genuine reasons. But separately from all of that, there is an enormous ecosystem built around Bitcoin specifically designed to convince people like Jessica to put money in at exactly the wrong time. That ecosystem is what we are going to talk about today. Not whether blockchain technology is valid, not whether decentralized currency is philosophically interesting, but why so many intelligent people end up losing money on Bitcoin anyway. Let us start with something simple, the pump and dump cycle. This is not unique to Bitcoin. It happens with penny stocks, with meme stocks, with cryptocurrencies, with any asset that has high volatility and relatively low liquidity. The basic mechanism is extremely simple. A group of people, sometimes coordinated, sometimes just following similar incentives, start buying an asset. As they buy, the price goes up. As the price goes up, media attention increases. CNBC starts covering Bitcoin. Twitter starts debating it. Podcasts start interviewing Bitcoin enthusiasts. The attention creates FOMO, fear of missing out. New people see the price going up, see the media attention, see their friends talking about it, and buy in. The new buyers push the price even higher. More attention follows, more new buyers. The cycle accelerates. At some point, the original buyers and the people who got in early start selling. They got in at $10,000. Now it's at $65,000. They take their profits. But the new buyers coming in think $65,000 is the baseline. They think it's going to $100,000. They think they're early. Then the selling accelerates. Price drops. FOMO reverses into panic. Everyone who bought near the peak realizes they made a mistake. They sell at a loss. The cycle completes. The people who got in early made life-changing money. The people who got in late lost significant money. This is not a conspiracy. This is not even particularly hidden. This is just how markets work when there is high volatility and emotional decision-making. Jessica got in during the late phase of a pump cycle. She was buying Bitcoin from people who had already made their money and wanted to lock in their gains. She just didn't know that.
Now, let us talk about the narratives, because the money does not move just on price momentum, it moves on story. For years, the primary Bitcoin narrative was simple. Governments are printing money, inflation will destroy fiat currency, Bitcoin is digital gold, limited supply, cannot be printed, therefore Bitcoin will go up forever and protect your wealth. This is appealing, it is emotionally coherent, it offers a solution to a real fear. If you genuinely believe governments are destroying currency through inflation, then Bitcoin offering an alternative is genuinely attractive. The problem is, the premise is more complicated than the narrative suggests. Governments do print money, but that is not the same as destroying currency value. The relationship between money supply and inflation is real, but not one-to-one. Inflation comes from multiple sources. Money printing is one, supply chain disruption is another, energy prices matter, labor dynamics matter, expectations matter. Bitcoin narrative collapsed this into a single story: government bad, money printing bad, Bitcoin good. And for people terrified about inflation, that story was more valuable than accuracy. Here is another narrative that drove significant Bitcoin adoption: the disappearing middle class narrative. Traditional investing is rigged, the stock market is manipulated by Wall Street, real estate is unaffordable, wages are stagnant, you cannot win in the traditional system. But cryptocurrency is the new frontier. You can still get rich, you just have to be early. You just have to take the risk that the traditional system will not let you take. This narrative is also emotionally true. The middle class has been under pressure. Wages have stagnated relative to productivity. Wall Street does have structural advantages over retail investors. Real estate is expensive. All of that is real. But the solution offered by the cryptocurrency narrative is not actually real. Cryptocurrency has not created a new class of self-made millionaires any more than the lottery has. What it has created is a new asset class where people with information advantages and capital can profit from people without either. Jessica heard this narrative. She was not getting ahead in her nursing career. Stocks seemed rigged. Cryptocurrency felt like her shot. It was not that she was greedy, she was desperate, and desperation is more powerful than greed as a motivator. Now let us talk about the expertise problem, because one of the most insidious parts of the Bitcoin ecosystem is how it creates the illusion of expertise in people who have none. Someone reads a few articles about blockchain technology. Someone watches some YouTube videos about Bitcoin adoption. Someone reads the Bitcoin white paper, and suddenly they feel like they understand something that 99% of the population does not understand. This is actually true. They do understand something most people do not, but there is a huge gap between understanding the technology and understanding whether the technology is a good investment at the current price. Bitcoin enthusiasts often collapse these two things. They talk about the innovation, they talk about the adoption curve, they talk about the technology being revolutionary, and then they conclude, therefore, Bitcoin will go up. This is a logical gap. The technology can be revolutionary and the price can be overvalued. The innovation can be real and the asset can still be a bad investment.
Jessica understood that Bitcoin used blockchain technology. She understood the basic idea of decentralization. She felt like she understood something. That feeling of understanding made her comfortable taking a large risk on something she actually did not understand at all. Let us zoom out for a moment and talk about what actually happens at scale. Bitcoin started as a genuine alternative to traditional currency, an experiment in whether decentralized money could work. It was created in response to the 2008 financial crisis. It represented a genuine critique of centralized banking. But here's what happened. As the price went up, more capital flowed in. Institutional investors started buying. Hedge funds started trading Bitcoin futures. Square and MicroStrategy started holding Bitcoin on their balance sheets. El Salvador made it legal tender. The more institutional capital arrived, the more legitimate Bitcoin became. The more legitimate it became, the more retail investors felt safe buying in. The more retail investors bought, the more the price went up. The more institutional investors wanted exposure, because now it was a trend. At every step of this process, the narrative evolved. It started as a technological innovation. It became an inflation hedge. It became a store of value. It became a social movement. It became a get-rich-quick scheme. Each narrative attracted different people, but they all pushed price in the same direction, up, until inevitably it did not. Here's the part that makes this particularly insidious. When traditional investments fail, there are regulations. Securities law exists. If a company misrepresents itself to investors, there are consequences. If a financial advisor gives bad advice, they can be sued. If an exchange defrauds users, there are legal remedies. Bitcoin and cryptocurrency largely exist in a regulatory gray area. It's not quite a security, it's not quite a commodity, it's not quite currency. And because of that ambiguity, when things go wrong, there often isn't a legal framework for recourse.
Mt. Gox was the largest Bitcoin exchange. In 2014, it got hacked and lost $450 million in Bitcoin that belonged to users. It took years for users to get any of their money back. Most got back less than 30% of what they lost. FTX was one of the largest and most well-funded cryptocurrency exchanges. In 2022, it collapsed. It turned out the founder had been stealing customer funds and using them to make side bets. Billions of dollars disappeared. The founder was arrested. Users are still fighting for their money years later. These are not edge cases. These are the major platforms, and when they fail, users have minimal recourse because there is no regulation that requires them to actually hold customer assets safely. Jessica never lost money on an exchange hack. She was lucky, but that luck was the only thing between her and potentially permanent loss. So here's where we land. Bitcoin itself is not a scam. It's a real asset trading in real markets, but the ecosystem around it, the narratives that drive adoption, the expertise illusions, the regulatory gaps, the profit incentives of early adopters, the emotional desperation of people trapped by traditional economics, the media attention that drives FOMO, all of it together creates something that functions exactly like a sophisticated scam, even if technically no single person is breaking the law. Jessica lost $4,000 and learned a painful lesson. Other people have lost life savings. Some have lost more than that. Most lost because they did not understand what they were buying. They understood the narrative. They did not understand the asset or its valuation or the risks involved. The question that lingers is this: if an asset can move 60% in price in a year, if that price movement is driven largely by narrative and emotion rather than fundamental value, if the people promoting it stand to profit enormously from new buyers arriving, if regulatory frameworks do not clearly protect users, and if access to that asset is particularly appealing to people in financial desperation, at what point does the line between an innovative asset class and a sophisticated wealth extraction mechanism become indistinguishable? And if you can't tell the difference, which side of that line are you actually on?